Hey everybody, welcome to my trading game plan and happy Friday to each and every one of you. My name is Gareth Soloway, Chief Market Strategist here at verifiedinvesting.com. So we're going to look at the charts and data. I have some additional charts I want to show today on the overall state of the markets that are pretty eye-opening in my humble opinion. So again, all data, no BS. It is what it is. All right, let's dive right into the charts here and take a look. This is the S&P futures, right? So this is yesterday's price action. We had a pretty nice up move early in the day here. You saw the markets lifting off, and then essentially the second half of the day was a quiet sideways chop. Overall, volume was very muted yesterday. We did get the initial boost off of, normally people would say CPI was more important, but interestingly enough, yesterday jobless claims took center stage. And I talked about this yesterday, how jobless claims jumped to 263,000, which by itself is not a signal of recession, but it's a dramatic jump. It's the highest number in literally about a year. And that tells us something. It tells us, again, assuming this is a trend, we'll have to see what the next week's number is, but it tells us that there is continued weakening in the labor market. And the markets, again, got excited. So CPI was actually a little bit hot, right? The headline number was 1/10 hotter than expected. The core number, which is minus food and energy, was right in line, but at 0.3%. Now take 0.3%, multiply it by 12. If that stays, we are above 3% on inflation. Remember, the Fed mandate or the Fed goal was 2%. So we're not even close to 2% at this point, yet the Fed is looking to cut rates. And with that jobless claims number yesterday spiking, the markets got excited that maybe, just maybe, the Fed will do 50 basis points. I don't think there's a prayer in the world that it will happen, but the market is willing to take the dive and hope and pray for more cuts. All right, so we'll see next week. Remember, next Wednesday, the Federal Reserve will, I repeat, will be giving their rate decision, and it is expected with almost 100% certainty they will be cutting by 25 basis points. So that's really what we saw the markets pushing up on yesterday, even in spite of it being actually not good on the inflation side and really not good on the labor market side, which, by the way, is the definition of stagflation. And again, I don't think most of us were around in the 70s when you had stagflation, but it is not good. It is not good. Again, people losing jobs and then prices still going up. That's the worst of both scenarios. All right, into the charts we go again. Let's flip over to the S&P 500. Now, this was really interesting, guys. So remember, we have this wedge pattern that we've been following. The lower trend line on the wedge, which starts back in May of 2025, has really kept the market floating up, right? Every time it hits it, it gets a bounce. We've now hit it 1, 2, 3, 4, 5, 6 times, and we have still not broken to the downside. Now, as we've moved up, we've hit it 3 times now, right? So one was on the date here going back to, looks like into August, right? Second hit was in late August, and here we are in September, tagging it as of yesterday. So again, that's very, very important to kind of monitor here, because really the question now becomes is, does the market break out of a wedge pattern? Now, wedge patterns can break out. They can. It's technically, when you look at upsloping wedge patterns, if it does happen, oftentimes it's short-lived, like what they call a bull trap, where you get above it. And this is where the confirmation signal is of the utmost importance. And then it kind of gets everyone thinking, oh, here we go again. And then it kind of comes back down and crashes down. But let's watch it. And of course, right here, every day of the week, 9 o'clock in the morning, Eastern time, I will be keeping you up to date on, has it broken? Has it been rejected? Have we confirmed above this level, or vice versa? Have we come down and tested the lower end, and have we confirmed to the downside? All right. So that's what we're following, but we do know that right as of yesterday, we closed basically right on that trend line on the wedge pattern up ascending line. All right. Onto the QQQ. Qs yesterday eked out a little bit of a gain, a little over 0.5%. Now, it was weaker than the S&P, which I find very, very interesting because, again, we've seen recently, and this was even 2 days ago, the QQQ was weaker than the S&P. I'm watching today to see if that is the case still. And again, what does that mean? It basically means, in my humble opinion, that you're seeing money rotation. So we're at a point in the market where there's so much money that's already in the market, margin levels at all-time highs, right? Institutions are involved. You have retail, which has gone all in and then some, okay? All of these scenarios are making it where there's not a lot of new money coming from the outskirts. And so for the markets to go up, what do we have to see? Well, when Broadcom rallied on earnings, Nvidia fell because money rotated. When Oracle ran to the upside a couple days ago on those amazing guidance numbers, like, oh, we're going to do the best ever kind of thing. What did we see? We saw Apple getting hammered. We saw Meta down. All of those stocks that, again, we saw money flow rotating towards the AI trade there with Oracle and with Nvidia and some of those other ones. And so, again, as the money starts to run out, you get rotation, but you don't get a lot of new money flow. Now, listen, there's always new money, especially if the Fed is going to lower rates, right? There's always a little bit of new money. But my point is, it's not like it was 6 months ago or 3 months ago where there were trillions and trillions of money or cash on the sidelines from the retail investors. You don't have that quite anymore. We've really seen it lured into the markets. All right, so that's where we are in the Qs. If the QQQ pushes up, we have this beautiful parallel right here. You can see the orange line going back to basically the high pivot in June to the low pivot in August, late August, and right here in even later August. That creates this one trend line. And then we have this secondary trend line, which is a perfect parallel to that. If we go up, that would be resistance. And likewise, the lower end of that parallel is support. All right, so that's where we are on this front. Quickly looking at the US dollar, the dollar, which was down a little bit yesterday, is back up today. The dollar, I repeat, has gone to sleep. Why has it gone to sleep? Most likely because, again, we're waiting for the Fed next week. So, again, this is one of the issues with one of the reasons why I hate Fed decisions is because as a shorter term trader, I flourish on volatility, right? I need intraday ups and downs, and that's how I find trades. That's how we see opportunities. When you get to like a few days out from a Fed decision like this, everyone just stops kind of trading. I mean, you'll see volume in the market a little bit, but the point being is the volatility just goes like this, right? And that means that as a trader, I don't have as many opportunities, but it obviously comes back in time, as we always do see. 10-year yield real quick. 10-year yield broke down below this key support line here. We broke down one day, rallied back above the next, broke down the next. Yesterday, this is really interesting, guys. We have to zoom in, and it doesn't, to me, it doesn't look like it confirmed a break. To confirm, you had to close below yet the previous day's low, and it looks like it closed right at that low. And so we still are kind of waiting to see, is this a real breakdown in the 10-year yield, in which case we're going to see it go to like 3.92 to 3.88, or is it a fake out? I actually think it's probably a legit one, but that's my speculation. And remember, speculation doesn't get us anywhere. It's all about the charts and the data. But again, I generally expect yields to go lower because I do think the labor market is weakening. I actually do think that is occurring. Okay. Now, I did promise you guys some additional charts today that kind of speak to where the market is and why I continue to be cautious even when we're at all-time highs and even when we're seeing the markets just continue to go up, up, and away, right? I mean, it seems like, yeah, we get one small down day and then the next few days up, up, up. Now, listen, the markets aren't running up like 3% a day or even 1% a day. This is what we call a grind. A grind is where it's like a 0.25%. A 0.1%, maybe a 0.5%, and then a quarter, and then a tenth, then a flat or a small down day. That's really what we're seeing. So it's this slow grind, but it seems to go on forever. But again, the warning signs are there, and I want to take a look at some of these. So the first chart here I have for you guys is this one. This is what they call the Buffett indicator. The Buffett indicator, again, is the ratio of total value of the U.S. stock market versus the most current measure of total GDP. And the reason you pay attention to this is because you look for where it has a major difference in standard deviations, right? Standard deviations are where it gets really out of whack. And what we see here is that just before COVID, we were at two standard, or excuse me, this was just at the dot-com bubble right here in 2000. We hit two standard deviations. And then look at the collapse, and we know that the dot-com collapse. Then just before COVID, we got up above two standard deviations, and look at the collapse we saw, right? The markets obviously collapsed at COVID. Now look at this, all right? Now, when we had the Liberation Day sell-off, and I apologize, let me go back here. When we had the Liberation Day sell-off, that was this little dip here. And then now, look, we're even higher above that line. So we are well beyond two standard deviations from the historical trend line. And again, listen, does this tell us that it's going to reverse today? Does it tell us that it's going to reverse tomorrow? Well, tomorrow's a Saturday. The answer is no. What this tells us is it means that for me as a technical trader that follows the charts, I need to be on alert. I need to be monitoring things. Okay. Now, next, let's take a look at this one. This is the S&P 500 10-year PE ratio. And now listen, here's your internet bubble, right? So in all fairness, we're not as high as the internet bubble. That was incredible. But we are still at a 2+ standard deviations above the historical trend. And you can see again the trend here going back. This was your dot-com move. And then obviously your financial crisis low, which was a negative 0.9 standard deviations. And you can see, by the way, you can use this to kind of accumulate too, because when you get down into these lower zones, historically, it's always been a good indicator of a buying opportunity. And vice versa. I mean, if you were shorting at this upper area for the dot-com, you made a massive amount of money. And really, if you go back to 2020, I mean, you had COVID right there and the collapse there, and you could see two standard deviations, and we saw the collapse on the back of that. And then lastly, I want to show you this one. This is price to sales with standard deviations. And again, this one goes back to 2000. And this, by the way, folks, is now at a new all-time high based on that. Two standard plus deviations away from the norm. All right. So pretty incredible price action there. Now, a couple other charts that have me on alert. Another one would be the VIX. And I've talked to you guys about the VIX. The VIX continues to be low. The VIX is a good tell of fear. And again, essentially when the VIX is, let's say, less than 15, right now it's at 1472, anywhere between 10 and 15 shows complacency. Now, it's important to understand that the VIX by itself, it doesn't mean just because it's at 1472 where it is, it doesn't mean it's going to pop 20, 30% tomorrow, right? Or next Monday, let's say. So the VIX is more of a guide to say, okay, you are entering into a period of complacency. And we know historically, if you look at the VIX, and we can go back to the chart on the VIX, we know in general, right? Let me get rid of these couple trend lines here so we can just draw this in. In general, we know that when we are basically between, let's go down to 15, right? Here's 15, okay? When we are around 15, and I'm doing it 1530, to the low end, you can see, yes, it can stay in the low end for periods of time, like this was in 2024, but then look at the super spike. And then it comes down, and as soon as it gets basically below 15, spikes. Here it got down to about 12 or 13, spikes. Here it got right down below 15, and we had the big spike here earlier with Liberation Day, and now you're getting into that level. And so these are the things that, for me, I start to pay attention to. And again, it's important to understand that it doesn't mean, like, and I stress this many times, but I think it has to be said again, it doesn't mean tomorrow you're selling off, or again, and tomorrow's the weekend, but you guys get my drift. It doesn't mean that the next trading day is, okay, well, the VIX is below this, so it has to go up. It means it's a warning. And so what I do is, as a technician of the charts, I, number one, shut off emotion. So while everyone is FOMOing in, saying this market can never go down, I'm collecting my breadcrumbs. And I'm saying, okay, look at this. Look at the Buffett indicator. Look at the VIX. And in fact, let me show you a couple others that have me aware of something on the horizon. This would be another chart. Copper. Copper, this is what we would call a major bear flag. And copper is already down. And by the way, if somehow we were going to avoid a recession, even with Fed cuts, then copper would be a lot higher, right? Especially with the build out of data centers. I mean, think about that. All of a sudden, we're at a point where we need all this new energy. And by the way, that's one of my pet peeves, by the way. All right, you guys, I went on a rant earlier this week, but how messed up is it that these data centers are so incredibly energy hungry that all of us out there are going to see higher electric bills. Like literally, you all, including myself, our electric bills are going to go up because these data centers are pulling. In fact, we saw one of this in, I don't know if it was California or somewhere else, where they basically pegged their new, and this, by the way, a lot of the nuclear stocks went up because of this a while back, but they pegged their new expected value or cost much, much higher because of data centers and AI. And again, think about that. Are you guys making a lot of money off AI? You know, it's like AI, you know, you have your robot in your house that's doing all your work, so you don't have to have a cleaning person or you don't have to clean your house anymore. I don't have that. But yet all of our energy bills are going to go up substantially. Talk about inflation. Anyways, you guys know I always go on these ridiculous rants because I, yeah. All right. Anyways, point is, copper is a warning signal. Copper should be up here if the economy was going to be okay. Now, listen, I almost get a sense that people are like, hey, if we go into this is how the market mentality is right now. People are like, well, if we go into a recession, it doesn't really matter because the Fed will cut rates and then we'll zoom right out of a recession and it's all good. And people love cheap money anyways. That's the mentality of the market. Look back, and this is the kicker, guys. Look back at every previous recession that doesn't work out that way. Recessions, I've never seen a recession where the market literally goes up during a recession. Never seen it. And this doesn't mean it can't happen, but I'm an odds trader, right? I'm a probability trader. In addition, remember, if the Fed cuts rates next week and you look at every past market scenario where the Fed starts cutting rates, what does the market do? Doesn't go up. The market generally starts to trend down when the Fed cuts rates. Why? Because psychologically, investors begin to think, uh-oh, they're behind the curve. And when you see a 911,000 yearly revision in jobs, and then you see jobless claims jump up as much as and you can understand why people might start to fret. Now they're hoping for a 50 basis point cut. There's no way. You can't cut 50 basis points with 0.3% CPI, 0.4% with food and energy in there. There is no way. Otherwise, you and I are going to be, we're talking about energy prices going up because of data centers. We're going to be talking about we're going to be talking about food prices. All inflation's just going to start going up, and away. And so the Fed can't overcut here. They're going to have to honestly do one cut, and I bet they say data dependent, and I don't think the market's going to like that next week one bit. But again, how else do they handle it? What are you going to have 10% inflation again? That's not going to go over well. The other thing, guys, is oil. If you look at oil on a bigger time frame, again, we are now at a point where oil is starting to look like it's going to break lower. If we look again at oil is a great indicator of financial strength or weakness or economic. And you can see we had an upsloping trend line since 2021, bounced, broke, retraced. Guess what? Path of least resistance is down. All right, let's get into some stocks here that are moving today. Enough of my ranting and raving. RH today, guys. It got crushed on earnings yesterday. It's only down a little bit. I really don't have a level on this. This got to like 177. 177 down in this range right in here. There'll be some support, but it's not down enough. Adobe, same kind of deal, popped on earnings. It's up a little bit. I was joking with my traders. Yesterday, Adobe came out and it went up initially, and then it basically petered out and it's up a few percentage points. And I said to them, oh man, I guess they didn't BS people enough and tell them how great the next 5 years are going to be in terms of the growth, right? Meaning that, I still think it's the most ridiculous thing. And by the way, did you guys see Oracle, how it's come back in so much? Hit 345. It's trading at 305 right now. 345 was the other day. But the point again is that Oracle misses earnings, misses revenue, but then promises that their growth is going to just be so big over the next 5 years because they have so much great insight into how things will be over the next 5 years. And in my head, I'm like, okay, sure. It's like me saying, guys, my returns for the next, 5 years will be like 1,000%. Like, okay, yeah, I sure hope they are, but I don't think I'm going to do 1,000% a year. I mean, I would be great, but that's generally not what I've been doing in historically. Yes, I do great, and that's why I have a following, and you guys are amazing because of that. But again, would you push my stock up that much? Maybe you would. I don't know. All right. Anyways, let's get through a few of these charts, guys. Google is now a short in my book. It's kissing the upper end. This is a swing trade. Upper end here could go maybe as high as 245, but this move into the upper parallel is now signaling Micron is up. This stock reports earnings in about a week and a half, and people are already buying it thinking it's going to be the next Oracle. I love that because it pushes it up so much that I would start to think about maybe even pulling the trigger on a short if it goes enough up into earnings. My big level that I'm watching is taking the high from 2014. If it gets up kind of in this 260 to 270 range going into earnings, I think there's a good opportunity there for a short. MicroStrategy. So listen, Bitcoin's been bouncing. Look at the MicroStrategy chart. If this breaks, this stock is in trouble. Now, I think what's interesting here on MicroStrategy is that there's more and more competition. How many stocks out there on a daily basis are we hearing are putting a treasury together of Bitcoin and Ethereum and this and that? All of a sudden, MicroStrategy is not the unique one. And MicroStrategy, if you add up all their Bitcoin, and that's really the value of the company, it's the market cap is way higher. And so I hate to say it, but I think with the competition now on this, it is coming down. Let's take a look quickly at Bitcoin. Bitcoin is inched up. We saw a close above that level that I was saying it was likely going to close above. Yesterday, a good move. It didn't quite hit my next resistance at 117, but again, it is pulling back a little bit. But watch 117. If it turns around, that could be a little bit of resistance. And then next, guys, I wanted to touch quickly on gold. Of course, gold. We won't forget gold. Gold is up a little bit. Now, the kicker here is the topping tail is still in play. The way a topping tail gets negated is if you close above the topping tail high, basically 36.75. If gold can close above 36.75, then the one bearish indicator here gets negated and maybe it continues up. But right now, it still technically has teeth. Silver's starting to look better here, guys. This bullish pattern we were talking about starting to break out. First resistance on silver will be around $44. Let me bring up this chart. There's this one little pivot going back to 2011, which is your last big resistance before 48 to 50. And so watch 44. That's where we could be headed. It might stall there, but then let's see if it can break above that and head to $48 to $50. We already looked at oil. I'll quickly look at natural gas, then I got to get going with you guys. But if we flip over to nat gas, again, nat gas pushed up, hammered on the trend line, closed above, didn't confirm, stayed above, didn't confirm, and then back down it goes. Resistance, it still has not confirmed above 320, so the path of least resistance technically is down in the near term. All right, guys, lots of information today, lots to absorb. I get that. I always want to bring a lot of stuff to you guys because, again, as a data-driven show that ignores the hype and all that other stuff, I think it's important that we focus on all of these different factors just to keep an eye on them, right? Again, to understand that while markets could continue to grind up, the warning signs are just mounting more. And I mean, like every day I'm seeing another, 2 standard deviations above the norm of this. And all right, copper saying this and oil saying this and the VIX saying this. Again, you could have 100 breadcrumbs and maybe the markets can still inch up for a little while, but eventually, they say the straw that breaks the camel's back. We're going to watch for it. At some point, it's going to happen. All right. You guys have a great one as always. Thanks for tuning in, guys. Appreciate all your comments. I didn't get to questions today. I apologize. Next week, I will get to some questions that you guys are asking in the comments. So keep asking them. We'll accumulate a list and I will get to them. You guys have a good one. Take care.